Stop sharing and start sharing. Let's see. Oh, my network is so strange again. Just a moment, I'm trying to figure out what is the problem. Thank you. Okay, our first slide, we are looking at the topics that we are having. We have got 12 topics to cover this side in management, accounting, and finance. Our first 6 topics, we have got the costing or the context of costing. This is just the introduction of our module, trying to make us understand what is the difference between financial accounting and management accounting. Then under unit 2, we have got terminologies and cost classifications. These are just terms. Mostly these two guys, we haven't seen them in our assignments and our exam for a while. Then number 3, we have got elements of material or inventory. This one is one of our favorite when it comes to the exam. The element of labor, it goes with unit 3. Unit 5 is material. Unit 6, this is supposed to be unit 6, elements of overheads. Then our unit 7, this is our main focus for today, guys, our CVP, because our question number 1 in your case study comes from CVP. Let me see what we put on here. CVP is 6. Okay. Our unit 6, this is going to be our a unit which is going to be of our main focus for today. Then we also have got some more. This slide is loaded. We have unit 7, job costing, different ways of job costing. We have got 2 ways of process costing in unit 8. For our unit 9, we have got joint and byproduct costing. These are 2 different methods that you must know. We have got ABC costing is another way of costing our product. Then our unit 11, budgets and budgetary controls. Then we have got a unit 12 for relevant costs for short-term decision making. These are our topics, guys, which we are having. You can see that we are fully loaded. We are fully loaded. We have got a lot to do. Because of that, we have got our tools which we are going to be using is the module guide. The examiner, our number 1, guys, is the module guide. The examiner does not have a choice but to examine you with what is in the module guide. So we are going to make sure that we understand all the examples which are in the module guide. We are going to assist the examples on the module guide with our online lessons, which we are going to be doing in the evening. I don't know what you agreed, guys, how many times a week. I still have to check your timetable. Then to make sure that our online lessons are successful, we are going to be doing homework. I will be giving you guys homework. You practice. Because here what we need, guys, we need enough practice. Then after that, our final month, which is the month of the exam, we are going to do our final push. In the final push, we are going to be only looking at the question papers, all the current question papers, because we have seen that the examiner for Mancosa have got a tendency of repetition. So if you familiarize yourself with a list of 4 question papers, you are going to an exam warm and dry. What is our focus? Our focus in this case, we are going to start by putting our energy on the assignment, because we said for all our assignments, we want to get 30%. Then as soon as we are done with the assignment, look at our exam. Then we also try by all means to get our distinctions. Because our main focus, our first focus, guys, is assignments. I prepared this lesson so that we start with the preparation for assignments. For you to, if you do have the assignment, please can you share it to the group? I want you guys to see question number 1. Question number 1 requires us to be familiar with what is given under topic 6, cost, volume, profit analysis, the CVP. Can you share the cost volume, the case study, please, on the group if you do have it? But we won't look at it today, because we do have a lot to look at before we are in a position to answer question number 1. I want to introduce you to our first topic. I picked our topic number 6 because you can see, guys, we are fully loaded, and we need, in this module, we need to hit the road running. We will pick our topic 6 because we first want to be comfortable with what is in the case study. Then after that, we start the preparations for our exam. The first thing that we need to understand is to explain the underlying assumption of CVP. CVP, guys, is our unit 6, cost, volume, profit analysis. It's our question 1 for our case study. Then another thing that you will need to know before we break today is to explain the marginal cost accounting approach. Why are we preferring the marginal cost accounting approach? Because when we are using CVP, it is a requirement that we use our marginal costing approach. Now, before we do anything, you need to understand what CVP analysis is. Our CVP analysis refers to a range of techniques that are used by managers to make variable short-term decisions. CVP analysis is based on underlying relationship between 3 key variables. Our CVP, guys, is cost, volume, profit. We are making an analysis. If we are making an analysis, remember we said when we are analyzing, we'll be comparing. So we are going to be comparing our 3 variables. Our cost, when we're looking at the cost, we are looking at the cost of purchasing our inventory or cost of production. When we are in a manufacturing company, then the volume of units for our V, these are the units that we are producing. It can be referred to volume or units. Then our P is the profit that we are going to make after selling our units. Before we sell our units, remember there are costs that we are going to encounter. That's why it's called the cost volume profit analysis. So here we are going to be checking, guys, that if we change our cost, what is going to happen to our volume or profit? We are making an analysis. That's what CVP is all about. What happens to our cost and profit if we change our volume? That's what is meant by these three variables are intertwined. For you to make your sales, you need the cost, you need the volume, you need the profit. A change in one variable will definitely cause a change in other two variables. These three variables, guys, they go together. We want to analyze and check which variables changes. What happens to two variables if we change one? If we change our cost, what is going to happen to our volume and profit? That's what is meant by the CVP analysis. Yes, it's recorded. Is it not showing, guys, on your side that I'm recording? Because I think I recorded. And the recordings will be uploaded. Let me check again. Oh, Jesus. Jesus. Make a mistake. Can I check again that I'm recording on the right page? Okay. 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 Let's look at our next slide. Sorry for that. This is an example, guys, which is trying to assist us to understand what CVP analysis is all about. Our first example number one, if a company's production cost increases, yes, this thing. There's something blocking my view, guys. I'm trying to remove it. Yes. Okay. Okay, sorry for that. If a company's production cost increases, this is going to have a negative impact on its how many units it can produce, which in turn will have a knock-on effect on sales and profit. In this example, guys, let's say our production cost increased, is going to increase. Production of 1 unit is going to increase with 20 Rand. We are increasing our production cost. We need to see, remember we said these variables, they are intertwined, they are related. If you increase one, the two must be affected. What is going to happen to our sales if we increase our production cost? Our sales here are going to decrease because we are going to also increase our selling price. If we are increasing our selling price, we are going to have less people buying our product. Hence, our sales volume or sales units are going to decrease. Also, our profit is going to decrease. That's example number one. Then example number two, if a company experiences a surge in profit, we have got a lot of profit, it will want to increase its production quantity. And this will in turn will have an effect on its cost. If we are increasing our production quantity, our costs are also going to increase. So with the CVP analysis, guys, we are checking what is happening to our profit. Then we check how is our quantity or volume going to be affected, and in turn, how is our cost going to be affected? That's all we are going to be looking at. Okay, those are two examples that we are having. Then let's look at the effects of changes in variable cost on profit. One of our Our variable, remember we said is cost. If we change our cost, what happens to our profit? If all other variables remain constant, an increase in variable costs per unit will, number one, it will increase the variable cost in total cost per unit. That is an example that was given. Let's remove it for now. Then if we said if all other factors remain constant, an increase in variable cost per unit, what will it do? It will decrease the contribution or the marginal income per unit and in total. That's if we are increasing our variable cost. Our costs are going high, then our contribution will be also be affected, is decreasing. What is going to happen again? We decrease the contribution or the marginal ratio. We also decrease the profit as long as our variable costs per unit are increased. It is going to affect our total variable cost. It is going to also affect our profit. Our total variable costs are going to increase, but our profit is going to decrease. Our last line of profit. That is how our variable costs have got an effect on profit, the last line. If we increase our variable costs, our profits are going to decrease. Another statement that we need to understand on CVP, if all other factors were kept constant, if the factors are constant, they are not changing. The following will be examples of changes that will lead to an increase in profit. Now we are looking at what is going to increase our profit if all the other factors don't change. The increase in selling price. If we don't increase our variable cost, we only increase our selling price, our profit will increase. Remember, we said all the other factors were kept constant. The increase in sales in volume. If we increase our sales volume, our profit is going to increase. If we decrease our variable costs per unit, our profit is going to increase. These are our expenses to make our product. If we decrease in total the fixed cost, also our profit is going to increase. Here we are looking at what can make our profit to increase, because in CVP we are checking our profit, our volume, and our costs. Those are the three variables which we are looking at. Then another statement, if all other factors were kept constant, are not changing, the following will be examples of changes that will lead to a decrease in profit. What can decrease our profit? If we decrease our selling price per unit, our profit is going to decrease. If we decrease the sales volume, our units which are being sold, if we decrease them, is going to affect our profit will decrease. If there is an increase, guys, in variable cost per unit, the cost for manufacturing the product increases, our profit also will decrease. If we increase the total fixed cost, also our profit is going to decrease. These are the statements which are trying to enforce what CVP is all about: the changes in profit, the changes in volume, and the changes in costs. Now, if you check again under this topic, for us to be in a position, guys, to use our CVP, we need what is called a marginal income statement. This is a requirement. We must familiarize ourselves with a marginal income statement as long as you are answering a question from the CVP. we are going to understand the marginal income statement for the rest of the evening, so that we are in a position to move on, guys, and proceed and be in a position to answer our question number 1 of our case study. Okay, what is an marginal income statement? A marginal income statement is a variable costing basis, is another term for the marginal income approach. You are going to be meeting these two terms. It can be called variable costing or marginal costing. It's just one and the same income statement. Under this approach, the production cost will only include variable cost. Please highlight that part. We are going to be only interested on variable cost to calculate our contribution per unit. Marginal income, we are calculating contribution per unit. We must bear this in mind, that we are only interested, if you are given a question, only look for variable cost. You must remember that you are using the marginal income approach. What are variable costs? The variable cost, we have got direct labor, direct material. The second one must be direct material. Direct material, then we have got variable sales and variable manufacturing overheads. I will show you these ones, guys, in an example. I will clearly show these ones in an example which I prepared for tonight. These are what we call our variable costs, which we are going to be interested on for today. What happens about the fixed cost when we are looking at the marginal income statement? All fixed costs are excluded from production cost. All fixed costs are excluded from production cost and are expensed in the income statement in the period in which they are incurred. I will show you guys how we exclude all the fixed costs. We first direct our interest in the variable cost. Now we have got these ones, the fixed cost. What do we do them? What do we do to the fixed cost? We expense them. I will show you how we do this. They are excluded from production cost, but we expense them. We don't ignore them at all. We start by concentrating on variable cost. Then the fixed costs are the last things to be concentrated on. I will show you in our framework. Then the marginal costing system works differently from the traditional absorption costing or full approach, in which production costs include both variable and fixed costs. There's another method which is given in your module guide, which is being compared, guys, to the marginal income approach, the absorption costing method or full approach. It is just highlighted in your module guide, but we are not going to be using this one because here we are management, accounting, and finance. In finance, we are only interested in the marginal income approach, not the absorption costing method. The absorption costing method is different from the marginal income method because this one uses both variable costs and fixed costs. Remember, I said with marginal income, our focus will be only on these four, our variable costs, when we are valuing our production cost. The last statement is telling us about absorption costing. The absorption costing approach is mostly used for external reporting. External reporting is for management accountants, whereas the marginal costing approach was developed principally to assist in internal short-term planning, controlling, and decision-making. This one is for financial accountants, the marginal costing approach. In this module, we are only interested, guys, in marginal costing approach. The absorption costing approach is just highlighted for you to know that we have got two approaches. The other one is for management accountants and the other one is for financial accountants. I will show you the framework and we are going to. No, you can't. You cannot be tested on absorption costing. This one is for management accounting, not the financial accountants. I just prepared differences between marginal costing and absorption costing. This one, in marginal costing, the variable cost allocates only variable manufacturing cost to the product. This is what I showed you: direct material, direct labor, variable manufacturing overheads. Then absorption costing, it allocates all variable and fixed manufacturing overheads to the product. We put our direct material, these are variable, direct labor are variable manufacturing overhead is variable, then we have got fixed manufacturing overheads. I will show you how we are going to be using this, but if for absorption costing, we are just showing you this, we are not going to be using it. The next thing that I want us to look at now is the framework that we are required to use for variable costing income statement. If you check under 6.2 in this topic, you are required to prepare a marginal income statement for NOMSA manufacturers. That's what I want us to look at. Before we calculate that, we need to see the framework. I'll stop sharing this document and move on to another one. Okay. This is the framework which we are required to follow when we are making marginal costing. We are using marginal costing method to make our income statement. We have got the column for per unit and for the total. The first item, guys, that we are going to be having. Remember, here our main focus is to calculate profit. Then our first line is going to be sales. You need to be in a position from a question to identify how the sales volume which were sold. Here you need to be very careful because some questions will require you to calculate the sales. The question will provide you both with a production and sales volume. You're supposed to be in a position to identify which one is the sales volume. How do we calculate our sales? The sales amount, the total sales amount. We are interested on the last line. We are going to say our selling price per unit times our total sales. That's what you must be in a position to look for in the question. After doing that, we need all our variable cost. Why variable cost? We are using the marginal costing approach. We are trying to make our marginal income statement. Then I gave you a list of variable costs. I said there are 4 variable costs that you must look for. The first one in the question, you need to look for direct material. when we get our variable cost here, we are going to subtract them from ourselves. But our first point, guys, how do we get our total variable cost here? We are going to add our direct material to our direct labor. Direct labor will be also provided, and variable manufacturing costs will be provided. We are going to be given per unit on this line. You are required to calculate the total amount. Then you add the three, then you get the total manufacturing cost for this line. After that, we look for variable non-manufacturing overhead. What are variable non-manufacturing overhead? Variable non-manufacturing overhead, guys, can be either administrative expenses or selling expenses. The question will guide you. If you see that it's administrative expenses for manufacturing, for non-manufacturing, variable non-manufacturing overheads, you must remember that we are putting them under our variable cost, even though they are non-manufacturing. In marginal income approach, we group all our variable costs. Then if we add our total manufacturing cost and our variable non-manufacturing overhead, the total that we are going to get, we put it here. So in this case, we need to number our stages here so that it doesn't confuse us. For numbering. Okay. How are we going to remember these stages? Which stage starts followed by which one? The first thing that we need here, we need our number one, which is our sales. After the sales, we leave the variable cost because we first have to identify our direct material. After that, we identify our direct labor. We identify our variable manufacturing cost. It's going to be our step number 4. After that, we add. We will also include the word add so that you remember that you are adding. Then we add again our step number 6. After adding these two, we now go back to our number 7. The total that we got, we put it here as our variable cost. Here, we are going to say we are going to be sub-adding. We take our direct material, we add it, we include the word add here. What did I do? So that we don't forget what is it that we are going to be doing. This one, we add it to our direct material and we add this one together. Then after that, we add and get the total. After that, we move to our stage number 6. Also, we add the two totals, 5 and 6 together. The total that we are getting here, guys, for 5 and 6, it goes to 7. So here on 7, remember we said we are adding our step number 5 and our step number 6. We are going to try and understand this in our example. Then after that, okay, I will explain that. Can I first finish our stages here? If we get these two, our sales and the variable cost, we are going to now get a total here equals, we go to number 8, what we call our marginal income or our contribution. How do we get this one? We said 1 minus 7, like this. One minus 7, like this. Then after that, we move on. If we get our total, we'll put our total here. Then we proceed to our number 9. Our number 9, we have to get our fixed cost. You go to the question again, it's gonna be written fixed manufacturing cost. We add them to fixed non-manufacturing cost. The fixed manufacturing cost, guys, will be given as fixed manufacturing cost, but the fixed non-manufacturing cost, you can be given as the fixed selling or marketing cost or fixed administrative cost. These are fixed and non-manufacturing costs. If you add this column, you will get your line number 9. You are adding all your fixed items, then you are going to add your number 10 and your number 11. Here we are adding to get our number 9. We are adding our number 10 plus, where's my plus? Plus on here, plus our number 11. That's how we get our 9. We put our total, then we do our final, which is our number 12. How do we get our number 12? To get our number 12, we take our number 8, our contribution, which we calculated, our number 8, then we subtract our number 9, like this. Then we are getting our profit. If we get our contribution or our marginal income here, we are going to subtract our fixed cost, then we get our net profit. Here I've got 2 types of costs, the variable cost and the fixed cost. The variable cost, we said these are the costs which are changed, they change when we are looking at the volume produced. If we produce 10 units and we produce 100 units, our direct material which we are using is going to increase. If we are producing 10 units and the following week we produce 1,000 units, the direct labor cost which we encounter will change. So these costs which are changing, we call them variable costs. Then we have got these costs which are not changing, the fixed cost. The fixed cost, like rent, it doesn't change. If you produce your rentals, doesn't matter how many units are being produced. If you produce 100 units and produce 1,000 units and you are renting a building, you are not gonna be charged per unit that were produced, but your rent is fixed, it doesn't change. Fixed means that those costs which don't change, but a variable cost are the costs which change when related to the production volumes. To try and understand, guys, this format, let's do this example together. This is example 6. Let's look at what is required from this example. Okay. Our example 6.1, we've got NOMSA Manufacturers Limited, manufactures and sells children's socks. The company manufactured and sold. As long as you meet a number, you must teach yourself that if you come across a number, you highlight the number so that when you are trying to answer the questions, the numbers are clear and visible to you. We sold 3,500 units at a selling price of 40 Rand per unit. So this was the selling price per unit. We are taking out all our numbers because we are preparing an income statement and we are going to use them. The company pays a commission of 5%. We are paying 5% on sales. To each sales representative, the following additional information is available. We are given, guys, direct material 5 Rand, direct labor 6 Rand, variable manufacturing overhead 2 Rand. Sales commission, we need to calculate it. We are told that it's 5%. We need to calculate it. You are also given fixed manufacturing overheads of 20,000, fixed administration overhead of 23,000, fixed marketing cost of 25,000. And where are you going to put this in our framework? The framework that we are given. What is required? The requirement: prepare a marginal income statement for NOMSA manufacturers for the year. We are preparing, guys, the marginal income statement. How do we prepare the marginal income statement? I said our first line, guys, is sales. For sales, you need to go to the information and check how many units were sold. That's all we need to know here. When it's the sales, are we, guys, in a position to identify how many units were sold? From the given information, how many units, guys, were sold? We have got 3,500. Remember our first statement, the company manufactured and sold 3,500 units. So our units, we are taking them to our answer. For our sales, we need the total number of units that were sold is 3,500. And now we need to try and go back to the question, guys, and identify the cost, the selling price per unit. What was our selling price per unit? It's 40 Rand. Please, if you can see where we are getting the 40 Rand, you let us know. Then if after getting the 40 Rand, we multiply our 40 Rand to get our total amount. Our 40 Rand is the unit price is 40 Rand. If we say 3,500, guys, times 40 Rand, let's confirm that our answer is, what is our answer? What are we getting? How much are we getting? 140. Let's confirm the amount, please. 140. Is everyone okay when it comes to sales? Because sales is our first line. If you manage to identify the sales, you are getting your 1 mark. So before we proceed, is everyone happy here? Then I said after sales, the next line, we need the total variable cost. We need to subtract them here from our sales. But before that, we need to go and identify our direct material. Our direct material from our given information. How much is our direct material? Direct material, how much is it? Our direct material is 5 rand. So per unit, under per unit, guys, we put our 5. Then what is our total? We are going to multiply our per unit, 5 rand per unit, times our total units sold. How many units did we sell? 3,500. Now let's confirm that we are getting 17,500. Thank you, it's correct. This is how we prepare our national income statement. We said 17,500. Then another, wrong line. Another variable cost that we are having is our direct labor. Let's try and identify the direct labor per unit. Then we try and calculate our total direct labor for 3,500 units. Our direct labor is given from the information. It's written, guys. It's gonna be provided. Direct labor, it's 6 rand. You put per unit, we have got 6 rand. How do we get our total amount? We multiply our 6 rand times our units produced, which is 3,500 units. How much are we getting? Let's confirm the amount of 21,000. Are we getting 21,000? Confirmation, please, that the amount is correct. 21,000, okay. Then we move on, we go to our information. Let's try and identify our variable manufacturing overhead. Is there a line which is giving you variable manufacturing overhead? And how much per unit are we getting for our variable manufacturing overhead? We have got our 2 rand per unit. Is given variable manufacturing overhead. Everything will be provided to you. What you need to know here is where to put it. For variable overhead, we have got our 2 rand. Now we need to calculate the total amount. We say 2 rand times our total units manufactured, which is 3,500, like this. How much are we getting? 7,000. Thank you. Confirmed. Please, if you're getting a different amount, let us know so that we check. Then now we need the total manufacturing cost. How do we get the total manufacturing cost, guys? Anyone who can remind us, how are we going to get our line, total manufacturing cost? We can start by per unit, then the total amount. Anyone to remind us quickly, guys? How are we getting our total manufacturing cost? Thank you. Total manufacturing cost per unit is 8 direct material, direct labor, and variable. Thank you so much. So we are now adding our 5 plus our 6 plus our 2. Are we getting a 13? Per unit is gonna be 13. Then our total is gonna be 45,500. How are we getting it? We are going to add it here. We said 17,500 plus our 21,000 plus our 7,000. Like this. Then we get our 45,000. We still have got another line. If we go back to our format that I gave you, I said after the total manufacturing cost, we look for a variable non-manufacturing cost. So in this case, let's bring this line here so that you remember what is this. Every time, remember guys, sales commission is our variable cost. Why? Because it is changing. Sales commission is a variable non-manufacturing. It's non-manufacturing because this expense, we did not incur it, guys, during the production, but it was incurred during the selling period. Now, let's try and calculate our sales commission. Now the sales commission, please mark it on red. The moment you see sales commission and you're required to prepare the national income statement, remember, sales commission is a variable non-manufacturing expense. How do we calculate sales commission? Our sales commission, guys, is given as 5%. Let's go back and find out how our sales commission is calculated. Sales commission, the company pays a commission of 5% on sales to its representative. So for each unit sold, our sales rep gets 5%. What does that mean? It means that per unit, we are going to say 5% times 40 Rand. How much are we getting? We want to put in this line per unit. 5% of 40 Rand is 2 Rand. We must get 2 Rand. Here we put our 2 Rand. Then how are we going to get our total? We say our 2 Rand We take our 2 rand, we multiply by the total units sold. Total units sold is 3,500, like this. Yes, so our sales commission total is going to be 7,000. Let's confirm that, please. Confirmed. Thank you so much. Now we are in the contribution or our marginal income, our contribution line. Before we go to our contribution line, remember I said we go back to our total variable cost. All the total variable cost, we are looking at all the expenses, guys, which are variable, which we encountered for all the units that we sold. Hence, we take our 45,500, we add it to our 7,000 so that we get the amount for here. Let's add, guys, let's start with per unit. What is our total variable cost per unit? We put it in brackets because we are subtracting it. We want to see how much we remained with after only subtracting variable cost. How much did we have as our total variable cost? We are adding our 13 plus our 2, which is 15. That's per unit. We are having our 15. We put it in bracket. Then the total, we do the same, 45,500 plus 7,000. Let's confirm, guys, that we are getting 52,500. Okay. Can you confirm the 52,500? You said it's 45,500 here plus 7,000. That's how we are getting our 52,500. Then now if I subtract, we take our sales, we subtract our total variable cost, we get a line called contribution. We have got another line called contribution. What is our contribution or our marginal income? This line is called contribution, or sometimes it is referred to as our marginal income. Remember, we said we are using the marginal income approach. Let's come with the contribution. What is the contribution? How are we getting our contribution? Let's see. Let's see, guys, our contribution. Let's type our answers for contribution. How much is the contribution per unit? How are we getting it? Remembering the steps that I just showed you. The contribution or marginal income. You can try if you have forgotten. For the first lesson, a guess is gonna be allowed. Marginal income, guys, or contribution. $40 minus 15. Thank you so much. Yeah. Per unit, we are having our 25. Why 25? We said 40 minus 15. We said our sales minus our variable cost. This is how we get our contribution. Then we do the same with our total amount. We take our total sales of 140, we say minus 52,500. Then we get our marginal income here. 140,000 minus 52,500. Let's confirm that we are getting 87,500. Confirmed. Okay, thank you. After that, we proceed, because if here our focus is to calculate the net profit, we proceed, we say less fixed cost. Now we need to identify all our fixed costs, then we put them under our fixed cost column. We go back to our given information. We have got 3 kinds of fixed costs. The first one is fixed manufacturing overhead. These are fixed costs, guys, which were incurred during manufacturing. Then we've got another line, fixed administration overhead. These are non-manufacturing overheads. Fixed marketing costs, these are non-manufacturing overheads. We take them to our solution. The first line, we said we want fixed manufacturing overhead. Our fixed manufacturing overhead is gonna be 20,000. We are given in total, guys. Then our administration overhead, fixed administration overhead is 23,000. We are given the total. We can calculate per unit. Then the last line of fixed marketing overheads is 25,000. Now we need to fill the line, guys, which says let's fix the cost. How do we do that? We add our 3 lines, the 20,000 and the 23,000 and the 25,000. Are we getting, guys, 68,000? In bracket, because we said less. $68,000. Let's confirm that our amount is correct. Yes, 20, 60, 68. Okay. Then after that, we now can calculate our net profit. What is our net profit? Anyone to assist us with the net profit? How much is our line of net profit? How are we getting our 19,500? The net profit is 19,500, but our main interest here, guys, is on how are we getting it. For our net profit, remember we say our contribution, which is 87,000. It must be 87,500. Then we subtract our fixed cost of 68,000. These two amounts must give us 19,500 is our net profit. Marginal income minus fixed costs. Thank you so much. Then we get our 19,500. This is all you need to do, guys, when you are required to prepare a marginal income statement. We use our variable cost. The first line, remember, the first line we said, look for the sales. How do we calculate our sales? We say the total units sold times the selling price per unit, which is 40 Rand. If we multiply the two, we get 140. Then we subtract our total variable cost. The total variable cost, let's also put the stages on the solution so that people don't get stressed when they are revising. Said our step number one, we are calculating our sales. After the sales, we skip our less variable cost. We go look for our direct material. Our direct material is given 5 Rand. We multiply, guys, with all our units sold. Remember here, we only want units sold. But in this question, look at this, and you must never forget it. In this question, look at this statement. The company, oh, Jesus. The statement says the company manufactured and sold. The units that were manufactured and sold, and the units that were sold, remember here, is the same amount. In some questions, they are going to give you a different amount for the manufactured units and a different amount for units sold. And it must not confuse you, because you must remember that we are calculating an income statement. We want to see the profit that we made for only the units that we sold. So here we are going to stick to the units sold. After getting your direct material, you proceed to number 3, which is our direct labor. Then we also look from the given information, the variable manufacturing overheads. After that, you add the total. You get your number 5. Number 5, please remember we are adding the 3. Then you get our total. After getting our total, we move on and look for non-manufacturing overheads. These are variable expenses, but they were incurred after the manufacturing process. This is our commission. It is referred to as non-manufacturing overhead. Then if we add the two, our total manufacturing cost and our non-manufacturing overhead, we go back to our less variable cost. That becomes our stage number 7. After getting our total variable cost, now we can happily come and determine our contribution or the marginal income, which is step number 8. If we get our marginal income, we can proceed to our stage number 9 and 10. In this case, we have got also 11. Then after getting that, we can proceed to our stage number 12, which is fixed cost, we subtract all our fixed costs, then we get our last line, the profit. This is what we are trying to determine. Here, guys, we are trying to determine our net profit using the marginal income approach. This is our net profit. Any questions on the line, guys, which is given here and we don't understand where the amount is coming from? Any questions? Are we okay, all of us? Because I'm only getting one response from Stefan. Okay, Stefan. Then after this, guys, we are going, I will look for another question from the examples. I saw another question which is requesting for the marginal income approach on page. Where is it? There is another question. If you have got your study guide 6.10.3, can you see that part? The required 6.10.3. Do I have it here? That's going to be our homework. We need we are going to take that, guys, as our homework as promised. 6.10.3 is going to be our homework. Thank you, guys. If there are no more questions, we can call it a good night. I hope we are going to meet again. Good night. Thank you, guys. Thank you so much. Have a lovely evening.
Thanks, and have a good evening yourself. Bye.
Thank you. Bye. Makes sense.